Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story, kicking off the week with all eyes on Nvidia. Citi's Stuart Kaiser writing this: markets will be captivated by Nvidia earnings, but after that event, there are about 2 weeks without clear catalysts. Last quarter, Russell 2000 and S&P 500 equal weight both outperformed the S&P by about 200 basis points between Nvidia earnings and the March CPI report. We like positioning for a similar pattern. Stu joins us for more. Good morning, Stu.
Good morning. How are you?
Is fine good? Is 2 weeks of no data a good thing?
Honestly, it's going to be a really big test, because last week when you had kind of no data, the market was able to, or 2 weeks ago when you had no data, the market just sort of trended higher. You had a nice clean week. I think this time you have a 2 week window. It's right around month end. You know, the question I think is, with the market at an all-time high, do people kind of trim some risk and do you get a little chop, or is it everything's fine and dandy? Actually, if you add dandy, it makes it much more enjoyable.
It does.
If it's fine and dandy, I think you can kind of drift higher. So our view is strong earnings season, the same way you had a strong earnings season last time. That tends to favor large cap because they're generating the bulk of the earnings. Once you get out of that kind of earnings event, we do think you can get a little episode of broadening into that big June 12th day.
With the emphasis on a little episode and not maybe a durable broadening, why is that?
I think there's still, as you all have highlighted, there's still some anxiety, kind of in the system. I think a lot of it, to me, revolves around the labor market. I think that's the area that is by far the biggest risk to equity markets. And if you look at the KC Fed labor tracker or other metrics, there are some sort of cracks or little weeds kind of in the garden that you need to deal with. And I think that's going to kind of keep people a little bit conservative.
And you pointed to the idea that momentum has not recovered alongside the broader market. I was talking about that. We were talking about that earlier. I thought that was a really interesting point, that this isn't necessarily the GameStop frenzy that's going to fuel the everything up kind of moment, and yet you're still constructive. What do you take from that? The idea that momentum is not really driving this?
It might be a little bit of kind of buy the rumor, sell the fact type issue. You had very strong earnings from TMT companies. I think that's really what stabilized the market that week of kind of April 26 or so, right? And I think now that you've gotten through that period, people are probably taking a little bit of profits and maybe taking a little bit of risk off the table. I mean, we're back at all-time highs again. We were below 5,000 pre-TMT earnings. We're at 5,300 now. So I do think you're just seeing some people kind of adjusting positioning, and maybe it's sell in May and go to the lake type situation,
So is that what you're recommending? Do you feel fine?
I feel pretty good, actually.
Okay, that's different than fine. I just want to say that. One thing that you pointed to was initial jobless claims. And I thought that was interesting, because I remember when people used to care about those, and then they started to flatline, and then everybody ignored them. Is that going to be first-tier data this week?
Yeah, I mean, claims are important. If you think back to last summer, last June we printed 105 in non-farm payrolls. You got claims, kind of above 250. If we got a repeat of that, obviously the market's not going to like that combination of data. So claims matter. It's just tough when you're at such a low level. You would need a significant step up in claims, I think, to get people's attention. Kind of ticking up 10K here or there is not going to do it. You're going to need a significant step higher of claims to be disruptive.
Stuart, how do you read the inflation data? Because when we saw the bumps early in the year, it was just that. This is bumps, not a trend. Then we get one print that's basically in line, and everyone's all excited saying, okay, we're back to the disinflationary trend off of one report. Is that fair?
I mean, it's a good question. The reason people are taking it so well is I think they interpret the Fed as taking it very well, right? This is a Fed that has sort of a cutting bias to it. And I think the market is saying if you're printing 30 basis points of core CPI, that gives the Fed kind of leeway to cut later this year. If you keep printing 30 basis points of core, you're almost back to 4% by the end of the year. So, 30 basis points is probably not going to do it medium term. But right now, I think it gives people confidence that the Fed is kind of willing to cut in that environment. We said at the beginning of the year, your sort of uber bull case for markets is you soft land or you don't go into a recession, and the Fed does a couple insurance cuts behind that. because that gives you a strong EPS outlook, and potentially you get a little bit of juice on the valuation side. So that was kind of what could get you up to those 5,500 type levels. That's what the market wants, ultimately. It's what we all want. So, when you get data that allows you to confirm that a little bit, I think the market tries to run with it.
You've said for a while that when the labour market starts to weaken, you're going to get nervous. Mm-hmm. Your team is predicting that on the economic side of the research division.
Yep.
What does that mean for your call? Does it just become increasingly short-term and much more tactical? Is it much more difficult to have a longer-term view of where this equity market's going to be?
100%. I mean, we'd recommended hedging a little bit, the last month just to kind of manage that risk. The risk reward of the market is not what it was 2 months ago in our view. You've had, U.S. economic surprise has gotten quite negative. You've got some hiccups going on in the labor market. Earnings are strong, but it's starting to get priced in. So yeah, we're keeping it much more tactical. When you get volatility down to these levels, I think it makes a whole lot of sense either to hedge or to use options for your upside. I mean, you're paying sub 10 implied volatility for upside on the S&P. That feels like a very responsible way to have your kind of long exposure on. So yeah, we're much more tactical, much more careful, and I think the market is showing you that it's going to be responsive to bad news. Unfortunately or fortunately, we just haven't had that bad news.
How high is the bar for Wednesday for Nvidia? Got another call right now in front of me, this time from Stifel on Nvidia. Price target raised to 1085 from 910. The quote, beat and raise widely anticipated. Same thing came from Barclays early this morning. All signs still point to another revision higher. How high is that bar Wednesday afternoon?
I think it's a pretty high bar, man. The market's gotten used to them basically beating by $2 billion, every quarter for a number of quarters in a row. $2 billion used to be a big number. So I think it's the bar is pretty high, for Nvidia here. Perhaps a little less high than it was a couple weeks ago when, the market was sub 5,000 and there was a little bit of stress in the system. But the issue with Nvidia is it's been a huge part of revenue and earnings growth. It's also a huge part of market cap, which is why if you take the Nvidia implied move and, kind of multiply it by its market cap, it could move the S&P 40 to 50 basis points that day by itself. So, the bar is definitely high. The way we track sort of sentiment, it's not quite as aggressively high as it was last quarter. Last quarter, you had inverted skew, which means your calls cost more than your puts. That's highly unusual at the single stock level. Some of that has started to come out of the system. So bullish, definitely. Bar is high, but it does feel I think people are starting to just accept the fact that you can't continually beat by $2 billion every quarter, right? So I think people have kind of prepared themselves for a little bit. It'll be fine, I think.
You think it's going to be fine? You feel fine?
I think it'll all be fine, yeah.
Fine and dandy, which is actually better than that. I will just say, one thing that I find interesting is that we used to have companies that were bellwether companies, whether it was the banks, which no longer serve as that, whether it was Walmart, which maybe no longer serves as that either. It's sort of a Walmart story, not necessarily a macro story. Is NVIDIA serving more as a macro story in terms of AI adoption? Will we get a sort of broader read-through to the market and sort of the sentiment behind it from NVIDIA than just an NVIDIA story?
I think definitely so. I think NVIDIA has become a macro story. You see how aggressively it's even priced into the S&P 500. These events are like our market-based events. I think we've talked in the past, there's a view that AI, increases productivity and can potentially lift GDP growth on a go-forward basis. It has massive impacts on the labor market. So, AI at large is a macro story. NVIDIA is right now the cleanest, most direct way to trade that. So it's made that, a macro story. Eli Lilly and those with the GLP-1s, I think, would fall into that category as well. Those are probably the two sort of single stocks or themes that have become macro over the years.
Anne-Marie said it, data point of the week, right? Data point of the week?
Yeah, Goldman Sachs last week said $1,100 per share that they uplifted for NVIDIA. This is the data point, I think, whether or not the markets will be fine or maybe less than fine.
Wednesday, after the close. You got a word on Man City?
Sad.
Couple of words? Sad.
Are they the Mets?
Not fine.
No, they're not the Mets. Unfortunately, they're not the Mets. I root for the Mets of the EPL, which is the unfortunate situation.
I hear you.
Stu, it's good to see you.
Good to see
it's
you.
fine.
Yeah.
It's going to be all right. Stuart Kaiser of Citi. Thank you, sir. Let's turn to travel. Shares of Ryanair lower this morning with the airline saying summer fares may be flat despite low capacity. Ryanair planning to offer discounts to stimulate demand. And the CEO, good friend of ours over the years, Michael O'Leary, joins us for more. Michael, good morning to you and welcome to New York.
Morning, John. Great pleasure to be here again.
Great to catch up with you, sir. So let's talk about pricing.
Yeah.
Your own CFO said it was counterintuitive. Help me understand it. Capacity's down, prices are flat. What's going on?
Difficult to understand it ourselves. Like we've come off 2 summers of 20% plus price increases. So we thought pricing this year would be softer. We thought up 5 to 10. At the moment, it looks like it's flat to 5% through the summer peak. I think there's just a bit of consumer resistance out there. Capacity is constrained in Europe. We thought that would lead to stronger pricing. Easter was early. That means that April, May, June is a little bit softer. We still see pricing up through the peak, July, August, September. We're constrained because of Boeing delivery delays. But I think pricing is going to be softer than we had originally expected this summer. Good for consumers. Not necessarily quite so good for shareholders, but then we've launched a 700 million share buyback today, so that'll keep shareholders quiet while we look after consumers all summer long.
Just to be clear, the trend for summer then, soft right now, but you do expect prices to increase, fares to increase as the summer progresses?
Yeah, there's no doubt in the April, May, June quarter, pricing is down on the prior year. Now, we had a full Easter in April. This year we'd only half an Easter there. Pricing still looks, but it's up small. It's very weak, 0 to 5% through July, August, September. We've only sold about 40% of the seats in that quarter, so it could still be up slightly higher. It could be lower. We're reasonably relaxed. We have costs well under control. We've hedged our fuel forward for the next year. We've saved $450 million on fuel for the next 12 months. So we can use that to stimulate pricing. And when we've done some price stimulation in recent weeks, we've seen very strong responses from consumers. So I think consumers are there. They're a little bit nervous. Spending is weak. But when you give them a price incentive, the volumes are very strong.
Does this take some of the pressure off the 23 deliveries of Boeing jets that you're waiting for that could be delayed? Because ultimately, capacity is less of an issue.
Yeah, I mean, I don't think so, Lisa. I mean, I would prefer to take the aircraft. We could fill those aircraft through the peaks. If through July, August, September, we think travel will be strong, pricing will be strong. We regret the fact that we'll be 20 aircraft short. We've crewed up, so we have all the pilots and the cabin crew. Our labour will be a little bit higher in that second quarter, but volumes lower. We've had to pare back our full year traffic forecast this year from 205 million to about 200 million passengers. So it doesn't really help because we're geared up for the growth, and we're just going to be Boeing going to leave us 20 aircraft short.
You've always been known for being incredibly cost conscious, trying to bring a lower cost to the consumer. Are you trying to get a deal on some of these Boeing jets? Are you looking to maybe buy some from others, or say if you want to shift to Airbus, that's fine. I'll take your MAX 737 jet.
Well, we've already said when United came out with those stupid comments earlier in the year, we're not going to take those MAX 10s or MAX aircraft. We'll take them. If you don't want them, we'll take them.
Did
of
you?
Course. Yeah, no. They kind of they mumbled and then decided they were going to take them anyway. Look, aircraft deliveries are incredibly tight. Airbus and Boeing are running way behind on their deliveries. There's a real capacity constraint story in Europe for the next couple of summers. Manufacturers are delayed. Airbus fleet is 20% of the Airbus fleet is grounded because of the Pratt & Whitney engine issue, and Europe is an Airbus market. So capacity is constrained. Why it's a little bit surprising, pricing is soft this summer. We thought pricing would be a little bit stronger because of those capacity constraints. But hey, if the consumers are a little bit more price conscious, if they're a little bit more price sensitive, we'll stimulate. It's good for our business because we're the lowest price provider.
Michael, what are you hearing from Boeing at the moment? Because in the past you said you thought the deliveries could slip further. How much further are we talking?
Well, Anne-Marie, good question. I think two things. One, we're 20 aircraft behind. We're supposed to get 59 aircraft for this summer. We're only going to get 39 at best. But we do see signs of improvement in recent weeks. I think Stephanie Pope and the new team in Seattle are doing a good job. They're taking fuselages are not being taken from Wichita unless they're completely defect-free. But we're not yet seeing a speed up in the turnaround times in Seattle. They're still taking 12, 14 weeks to produce an aircraft, whereas it should really be 8 to 10. Now, 2 weeks ago, they sent us an update. We were expecting 2 deliveries in June, 3 in July. We're getting 2 in June. It looks like 7 in July. So we're beginning to see the situation improve, but it's very small baby steps. We're still going to take aircraft through August, September, and October, even though we can't fly them during those months. We think we get all 59 aircraft in this calendar year. And then the big issue with us at Boeing is, will we get the 29 aircraft deliveries we are contracted to deliver us between January and April of 2025. So I think they're making small steps, little progress, but we don't want to see any further bad news.
If that's your big question going into next year, then how do you weigh the impact, and what does that mean for your business for 2025?
I think at the moment it means that for 2020, for FY20 March 25, we're going to be doing 200 million passengers instead of 205 million. For March 26 or summer 25, we think we can step that up. I think we'll get most of those aircraft from Boeing, and then we'd like to see ourselves grow to probably about 215 million passengers through summer 25 into March 26. We think there'll be a strong rebound. We still think pricing will be reasonably robust across Europe because capacity is going to be constrained. Airbus and Boeing can't deliver any additional aircraft. The engine issue is a huge problem for the Airbus fleet. You know, they've been talking about 350 days to repair these engines. We think it's going to be 500 days. So a lot of Airbus aircraft are going to be grounded for the next 2 or 3 years.
How much do you see, just going back to this idea of pricing power, and that we're surprised that there's not greater degree of pricing power given some of the constraints with deliveries? How much is this sort of the end of the boom that we saw in the travel, and that people are constrained by the fact that, you know, hotel prices have tripled? You can see that any restaurant you go to is that much more expensive. Anytime you travel, I mean, it's incredibly expensive. So how much have we sort of reached the tipping point where we're going back to something that's pre-pandemic and not this you can work anywhere and travel all the time kind of mentality?
I mean, I don't think we've reached that. I think Europe is a fundamentally different market to the US. North America, you've seen a lot of travel price inflation in the last couple of years. You know, the average fare Southwest charged last year was $170. The average fare in Ryanair across Europe was 48 euros. So there's still a bit to go in Europe, but there's no doubt in my mind that the European consumer is cutting spend, is careful, they're cautious, they want price stimulation. We go out with seat sales, we sell out straight away. But, you know, we have higher interest rates, government's cutting back on inflation. I think consumers are just a little bit nervous there at the moment. I don't think that's a longer term trend. I think, you know, interest rates will fall, if not this year, through into next year. I think we will see some rebound in consumer spending. But I think they will protect travel. The experiential spend will continue. It'll just trend down to the lowest cost provider, which in Europe is Ryanair.
Is this a time to get more aggressive and go after market share in certain geographies?
I would love to. If I could get more aircraft out of Boeing, I'd be on it like a rash. We are taking more market share, though, at the moment in Central and Eastern Europe. Wizz have grounded 45 aircraft. Nobody else is expanding in Europe. So we are winning huge amounts of market share, despite the fact that our own capacity growth is constrained by Boeing delivery delays. So we're taking market share. I think that will continue. But if I could get more aircraft, I would try and grow faster at the moment, albeit at the cost of lower airfares.
You've got a good read on the consumer. Do they care what plane they fly on?
No. I mean, most of them don't know what plane they're flying on. I don't know what plane I'm flying on most of the time.
Do you not check?
No. I mean, if you look at whether it's the Boeing NGs, the Boeing Max, I mean, I prefer to fly in a Boeing Max aircraft only because A, it's materially quieter, and I know that plane is burning about 16% less fuel than the older fuel guzzly 737 NGs. Boeing are making great aircraft. They are getting a lot of unfair publicity in the last 12 months.
You think so?
You know, a nose wheel falls off an
What's been unfair about it?
A nose wheel falls off an Air Canada aircraft, or an engine cowl comes off a Southwest, and it's a Boeing aircraft.
Slightly concerning, no?
Yeah, but it's a maintenance issue for those airlines. It's not fundamentally a 737 issue. The 737 is a great airplane. They're making phenomenal new engines. I mean, the engine technology is being transformed. We can't wait to get the MAX 10s. We're due to get the first of them in 2017. They'll carry 20% more passengers but burn 20% less fuel. So not only will it transform our economics, but it will make us a much better, more greener, cleaner airline to fly on.
Michael, it's good to see you.
John, good to see you.
Thank you, sir.
Thank you very much.
Thank you.
Michael O'Leary there, the Ryanair CEO. Another busy week of Fed speak on deck. Bostic, Barr, Waller, Jefferson, Mester kicking things off later on today. Investors also looking ahead to the minutes from the last Fed meeting, jobless claims and UMich consumer sentiment. Joining us now to discuss around a table, Stephanie Roth of Wolfe Research, together with Mark McCormick of TD Securities. Stephanie, first to you. We heard from the Atlanta Fed president about an hour ago. He said things were softer in the labour market. They weren't soft. Would you agree?
Absolutely. We've seen a softening. The latest payrolls print was arguably a Goldilocks type of print where you had a 175 payrolls number, which is good by historical measures, and an average hourly earnings print that was on the softer side. We're starting to see some signs of softening. I have to say there are some concerns in the market out there that all of a sudden the labor market's going to start to crack, and there are no signs of that. I think people are just taking the narrative and running and taking the opposite of what we saw in Q1 and flipping it upside down. So that's not a fair characterization either. Realistically, we're just seeing a rebalancing in the labor labor market that's actually working out fairly well, in part driven by immigration.
Mark, to bring you into the conversation, should we flip Q1 upside down? Is that what Q2, Q3, Q4 has in store for us?
No, I would agree. I think a big part of it is the market's kind of taking what's a positioning and a technical narrative, and they're overlaying it into fundamentals, and you're seeing maybe some reversal. But if you look at some of the more important prints as well, like employment cost index, if you look at some of the other indicators that we track on inflation, there's no sign here that inflation's cracking. And to me, if you look in the details, it's still pretty robust and is relatively strong. So I think also if you put it in line with where the Fed's supposed to be, Fed is basically looking for 15 basis points month over month to basically get their 2.6% year over year. And it looks like even PCE, core PCE is tracking at about 25 basis points right now. So it still feels like there's a very big disconnect.
Stephanie, do you agree with that there's this idea that reflation or sort of a resurgence of an inflationary wave is the biggest risk right now and looks more and more feasible given the backdrop?
It's definitely the biggest risk. Is it one that I'm particularly concerned about? No, because the inflation data are starting to look a lot better. Q1 was certainly driven by seasonals, and in my opinion, Powell seems to believe that as well, although in the latest press conference he probably couldn't lean on that. But what we're starting to see is a real normalization in inflation, and the latest print told us that. And I think this was the most important clean read of inflation that we've gotten this year, because seasonals were really driving up Q1 inflation, and April was a lot better. So now we're tracking core PCE of the 25 basis points. If we just get OER coming back down a little bit and financial services, then you'll be back down towards 0.2%. 0.2% month on month, and that's exactly what the Fed is looking for. So it's very easy come the summer months to actually be tracking along those lines, and then the Fed should be able to be comfortable cutting in, say, September.
Even though you do still see this resurgence underneath the hood of just some sort of stickier inflation, commodity prices getting a little hotter. Mark, from your perspective, you're talking about how that's your fear. At what point is this driving flows internationally into the U.S. at a time when some people are saying, well, a weaker dollar can actually make sense? And other people say, well, just hold on a second, because on a relative basis, rates are so much higher in the U.S., strength is there, and the Fed won't be able to cut as much as, say, the ECB.
Yeah, it's very interesting because there's a clear focus on growth and inflation. And towards the end of last year, when we were bearish to the dollar, there was a convergence with the rest of the world coming into the U.S. And U.S. exceptionalism basically peaked last year. Everyone now seems to be overlaying this like fading U.S. exceptionalism now, which I think is quite interesting because this is more about positioning and this is more about valuations that were extremely stretched in favor of the dollar. And then you get a couple good data prints. But what we're seeing, if you start backtesting and trading FX strategies, the FX market basically just changed its focus entirely in March on inflation. So I think the one thing that's very interesting about the Fed is it's very asymmetric from a risk perspective right now. There is an election. It's the big elephant in the room, and there is no room for error for one inflation print to come in through the summer above expectations and still be able to reliably expect September to actually be live. And if you take out September, then you have November and December. So how is the Fed going to cut in November around the election? And given the results of the election, how could the Fed potentially cut in December? And so the way that we're thinking about it from like a trading perspective is that you could have inflation kind of go back to the levels that people are comfortable with. But do you price in 3 hikes? Do you get more confident that you just get 2? But you get one bad number, and that basically makes September a very tricky indicator, especially to trade it into the election. So I think a big part of this is we know that other G10 central banks are about to cut, but we're not very clear on whether the Fed can and whether they will. And I think the big driver here for the currency markets and for markets in general is inflation divergence. And that's what our models and our signals are telling us that we should be focused on.
And Mark, there's tons to unpack there. It's the politics that stands out for me. What convinces you the politics and the election is so important? When we go back to 2012, September, they announced QE3. Why does it matter so much more this time?
I think a big part of it is rates of inflation. So we can see that you get policy actions and it's usually not a problem, but inflation's way above target. And so it's like this would be the first cut with very elevated inflation in a very tricky election where the polls are neck and neck and there's just a lot on the line. It's a very contentious election just to even start. And I think the policy implications from one side or the other are so massive that the market is placing so much emphasis, especially for the FX market, because it is the most actionable way to look at the presidential implications in terms of tariffs, in terms of tax cuts. Those are two big things that are sitting on the table for next year. The corporate tax cuts will expire, and the discussions around tariffs will remake the entire currency market. And this also fits into the story around the geopolitics, around capital flows, where, again, if you look at what's happening with the renminbi, if you look at what's happening with currency markets, like China and Russia and emerging markets are aligned, where they are basically settling currency in renminbi. They're finding ways to kind of nudge themselves away from the dollar. And this is why gold is trading at the levels that it's at. So there are so many implications for this. And so I think with this in mind, the easiest thing to think about is how much can the Fed cut into the election if inflation's still well above target?
Stephanie, does the election matter?
I mean, I think the Fed's in a tough spot, and they've been in a tough spot all year. And Powell has indicated they're planning on cutting if the conditions are right. So it's purely on the last part of that statement, if the conditions are right, which means the core PC needs to be trending at about 0.2% month on month. And as Mark mentioned, it has to go exactly right in order for the Fed to cut. If they have a couple of missed prints in the next couple of months, then yeah, of course the Fed can't be cutting. But our base case is that you have a lot of conditions that should be continuously disinflationary between now and September, and then they'll be able to move. But at this point, they're kind of caught in a box, and they have to just go on what they've indicated as key benchmark indicators. And if those things are consistent with the Fed cutting, then they're going to be cutting. No, regardless of what they do, they're going to be painted as politicized. So it's a really tough one. So our base case is they can still cut in September. November's probably out, and then December is the next one.
But Stephanie, that's if inflation is on this trajectory lower. But if there's a move and a bigger softness in the labor market, that would give them this impetus and maybe some cover to cut into an election, do you think?
Absolutely. If you started to see softness in the labor market, they would have every indication to cut. And this is different from where we were a year ago. At the beginning of 2023, they were in a position where inflation was so high that if we saw weakness in the labor market, they couldn't cut immediately. But now we're talking about 2.5% to 3% inflation. That's a much different backdrop than when inflation was trending significantly higher. So they're now able to be a lot more nimble and even be able to cut interest rates even if inflation is still a little bit sticky, and lean on the employment side of their mandate.
Mark, you see that there's very little room for the Fed to be cutting rates, or you could see them not end up cutting at all this year just simply because it's inconvenient timing. At the same time, you see a resurgent inflation as one of the biggest risks. So put that together in terms of what's going to be the main driver of either dollar strength or weakness.
So yeah, I'd say in the last couple of months we flipped. We're quite bullish the dollar, especially against G10 currencies. I think that is the backdrop, that it's asymmetric, right? It's like from a risk trading perspective, like our view is that the Fed can cut. That's our economist baseline call. But I think when you think about the markets and how people have to deal with the risks around it, to me the risk is if there's no room for error, and data is extremely volatile, and we constantly have to look at revisions and these kind of things to understand the trend. The trend in U.S. inflation is quite different from all the other countries that you track in the currency market. So I think the other implication is that the asymmetric kind of outcome is one where, if you think about, again, the market was very excited that Powell said that there's no hikes. That's fine, but we were starting this year, the market was talking about 5 or 6 cuts, and now we're saying it's okay that we don't get any hikes at all, or we don't have to have that narrative discussion around it. But I think if you think about it this way, if we do have a more volatile fall and inflation's generally sticky, and the polls are kind of leaning towards kind of a change in leadership, for the dollar, it has to price in the risk of tariffs. It has to price in the risk that corporate tax cuts will be extended. So in a very strong economy that's dealing with elevated inflation, you now have macro policy that's moving more inflationary. So the market will have to reprice the expectations, whether or not it evolves in that way, but it will have to basically reprice a narrative next year that is, the rest of the world is cutting. The U.S. economy looks like it could get stronger, and the fact that you're adding tariffs makes it much more inflationary. So you kind of have to rethink the way that you look at the entire markets, particularly from the FX side. So for us, we are looking for a strong dollar against G10 currencies, but we also like the commodity story. So it's still a buffer for some emerging markets that are generally seen as exporters. But it is, again, kind of moving back into that terms of trade shock. And it's also a world where it kind of creates conditions where we were expecting financial conditions to ease this year to see the economy evolve in a better state. And if what we see is U.S. inflation and the Fed and the dollar creating a little bit of a tension around that, then we can't realize those financial conditions and we can't realize the growth expectations that were priced in this year for next year. So that's what starts to see the volatility increase. That's what starts to see carry trades unwind. This is kind of what adjusts market sentiment. And I think these are the risks that we have to be really focused on. And that's why we're more bullish the dollar in the back half of the year.
Stephanie, just to tease out one part that he was talking about, this idea that tariffs would mean that the dollar would essentially be stronger, that some of the protectionist policies that some people are talking about being implemented, especially if there is a change in leadership, would cause more inflationary pressures and would cause a stronger dollar because the Fed would have to remain higher for longer. Is that kind of an outcome that you agree with?
I mean, it's certainly a difficult one, and that might be how the market prices the election initially, but base case, first of all, the tariffs wouldn't go into place until 2026 because that's when the TCJA expires. Second of all, it's possible that the labor market is actually in better balance by the time the election comes, so the Trump administration turning off some of the immigration flows might not actually be as inflationary as many fear. And by the way, the Biden administration has done a lot of spending themselves. So it's not actually entirely clear that if we do get a change in administration, you'll start to get a real pickup in spending. Either way, we're going to be getting tax cuts extended. The Trump or Biden administration in the next cycle would be extending the tax cuts. It just depends if you carve out the upper income people, which is what the Biden administration would do. It's not going to be a boost to the economy, certainly when you're thinking about tax cuts, because it's actually just extending what we have today. And the tariff one is a difficult one, and I would view that as more, certainly it could be dollar positive, but it would also be an environment where growth would likely weaken as well. The policies that Trump has alluded to with a 60% China tariff or 10% across the board tariff would be incredibly difficult for growth. So realistically, it's possible it wouldn't actually be that inflationary. The Fed should probably just pause, see what happens, and then they would likely react. So it's not as clear cut as Trump is inflationary and the Fed would no longer be able to cut in that environment. That's not necessarily the case.
Mark, when it comes to tariffs and it comes to these tax cuts, both of these issues coming into play 2025, whether or not it's Biden or Trump, we're likely going to see more of the same. It just depends how aggressive they are going to be. So in that case, what do you have in terms of the direction of the dollar under a Trump 2025 or a Biden 2025?
I think the part of it is that with Trump, it just creates more uncertainty, more volatility. And again, like the way the markets are trading, the currency market right now is they're actually trading, and I hear it a lot from client discussions, and it's really the fact that the rest of the world is improving right now is why people want to sell the dollar. And we're a bit confused about it because a lot of our leading indicators are kind of suggesting that the global economy is not accelerating, it's kind of losing steam. But there was obviously some anecdotes that China's trying to clean up the housing market. The things are improving in the right direction there. Commodities are doing quite well across the board, so maybe that's, again, part of the reflation. PMIs in manufacturing, those things are bouncing back. So people are excited about the global economy and the slowdown in the U.S., and that is so you have to unpack it, too, as well, because laying out like slower growth and those type of things that would come from maybe a Trump administration is bullish dollar because it's risk off. And then, the world that the people are trading right now is kind of risk on. U.S. is slowing, but not by enough, and you can get Fed cuts, and this is dollar bearish. So I think what people are trying to figure out is which matters more, U.S. growth outperforming others, U.S. inflation being stronger, therefore the Fed has to react to that, or whether or not in a Trump administration, does the rest of the world underperform? Like, do we get the rug kind of pulled out from us right now as the rest of the world seems like it's doing okay? Europe's leading indicators are improving. Does that all go away under a Trump, kind of a Trump presidency, which is what we saw the first time around, which is the U.S. kind of outperformed the rest of the world. U.S. growth looked good because basically tariffs and the macro policies were administered basically slowed down the rest of the world. So I think that is kind of what people are trying to figure out is a high inflation kind of weak growth environment good for the dollar because we kind of move out of this Goldilocks environment. Everyone's moved back to Goldilocks, and I feel like any state we go through over the next 6 months is not Goldilocks. It's either it's something that's more volatile and the volatility, and again, there's first order and second order effects. The first order effect is you basically pricing the risk premium. Second order effect is we actually agree of like if Trump wins, it's actually, you could see the dollar weaken dramatically after the first year. You could see the implementation of a new Plaza Accord. But those are a result of the fact that the dollar strengthens so much to price in the risk around these economic policies.
Stephanie, you've been nodding. Final word.
Yeah, I mean, I think it's a complicated backdrop. For now, it's going to be all about Fed policy and whether inflation can be consistent with the Fed being able to cut. The market's not going to be able to fully price in the election, certainly at least through much of the summer, and probably not until the beginning of next year when we start to really understand what those policies mean. So for now, it's going to be all about whether the Fed can be a little bit more dovish, which arguably in the first quarter, we think we just passed peak hawkishness. It was all about the U.S. exceptionalism and inflation overheating. But if you just remember back to December, we were talking about the opposite. It was immaculate disinflation. We've just been swung around by the data. And it's really all about just looking through a lot of that noise. And what we're looking at is inflation running 2.5% to 3%, a little bit too sticky, but nothing that's that dramatic, and an economy that's starting to slow down a little bit. So for us, it does actually look fairly Goldilocks, at least for the next couple of months.
Stephanie, this was great. It's good to see you. Stephanie Roth there of Wolfe Research alongside Mark McCormick of TD Securities.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.